Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
It's good to be back. And, looking at the stack of papers on the desk today, headlines feels like a bit of an understatement. It feels more like we're watching tectonic plates shift under the global economy.
I was just thinking that. It's Thursday, February 19th, 2026. And if you just, glanced at your brokerage app yesterday or even this morning, everything looks great.
Green arrows everywhere.
Totally. U.S. indexes were up, Europe's looking positive, and tech. Well, tech is just acting like gravity doesn't apply to it.
It looks like a party on the surface. But our job is to look past all that. Because when you actually dig into the sources we have, I'm talking Bloomberg, CNBC Daily Open, the data from Yahoo Finance, you find this massive contradiction staring you right in the face.
It really is. It's like we're reading two different scripts for two different movies. On one page, the stock market is hitting record highs.
And on the other, the Federal Reserve seems to be quietly having a nervous breakdown about inflation.
Nervous breakdown is a polite way to put it. We're trying to reconcile a market that's in full risk-on mode with a commodities market that is screaming, "Run for the hills!"
And you can't have both be true for very long. I mean, something has to give.
Okay, so let's start right there in the engine room. The Fed. The minutes from their late January meeting just dropped yesterday. And the whole story for months has been cuts are coming.
That was the narrative. It was all about when, not if.
Right. The market has priced in cuts. My mortgage broker is calling me about cuts. But that's not what these minutes say, is it?
Not at all. It's a completely different and, frankly, a very confusing story. According to both Bloomberg and CNBC, while the street is betting the farm on rate cuts, several Fed officials were actually talking about the possibility of hiking rates.
Hiking in 2026. Wait, hold on. After everything, they're talking about going up.
That's the bombshell. And it wasn't just, a stray comment. The minutes say several of them were worried that easing policy now could be misinterpreted.
Misinterpreted as what?
Yeah.
That they're giving up.
Exactly. That they've surrendered on that 2% inflation target. They're seeing sticky prices that the stock market is just, choosing to ignore.
But the vote itself, they did hold. Right. They held steady at that 3.5 to 3.75% range.
They held. But the vote count is where the drama is. It was 10-2.
So 2 dissenters.
Right. Governors Christopher Waller and Stephen Barron. Now, usually when you see dissenters in a hold meeting, you assume they're the hawks, right? That they wanted to tighten.
Yeah, that they wanted to hike.
Nope. They wanted a quarter-point cut. So just picture that room for a second. You have two guys who want to cut now. You have the majority voting to hold. And then you have a vocal group within that majority saying, hey, actually, we might need to hike soon.
That is a fractured Fed. That's not a consensus. That's a brawl.
It's chaos. It tells you the data is so messy that the smartest people in the room can't even agree on which way is up. And when the Fed is confused, volatility tends to follow.
And it's not just internal confusion. The external pressure is boiling over. We know President Trump has been extremely vocal. He wants lower rates like yesterday.
He needs them. His whole economic plan relies on cheap money. And he's already nominated Kevin Warsh to replace Jerome Powell in May. So Powell is basically a lame duck chair walking through a minefield.
And the White House isn't being subtle. I was reading the CNBC summary. They quoted the spokesman, Kush Desai, saying inflation is cool and stable.
Cool and stable.
And he credited Trump's supply-side policies. But you hold that quote next to the Fed minutes talking about persistent inflation risks? Are they even looking at the same economy?
They're not. And that's the danger. The White House sees the political calendar. The Fed is looking at the data. And usually this tension plays out in, some pointed press conferences. But this time, it's getting weird.
I'm glad you brought this up because I saw this in the Reuters feed and I thought it had to be a joke. There's a lawsuit threat.
You literally cannot make this up. In the middle of this huge monetary policy debate, President Trump has renewed a threat to sue Chair Powell.
But on what grounds? Mismanaging inflation.
No, that would almost make sense. He's threatening to sue over the management of renovations at the Federal Reserve Building in D.C.
You're kidding me. Over drywall.
Drywall and scaffolding. I mean, the CNBC report had pictures of the construction around the Eccles Building. Apparently, the president is furious about the cost and the pace and is threatening personal legal action against Powell for, quote, gross mismanagement of a building project.
That sounds like a dispute with a condo board, not the central bank.
It's symbolic, though, isn't it? It just shows a complete breakdown of respect. If you're willing to sue the Fed chair over the lobby, there's zero chance you're working together on monetary policy. It just makes the market incredibly nervous.
So, fractured Fed, hostile White House, and a lawsuit over building permits. If I'm an investor and I hear the Fed is whispering about hiking, I am not feeling good about my risky assets.
And that is exactly what the smart money is doing. Which brings us to the second massive contradiction of the day, the mad dash for safety.
I saw the Bloomberg piece on this. Gold.
Gold is the canary in the coal mine here. It has recaptured the $5,000 level.
$5,000 an ounce. Wow, I remember when 2000 felt like a crazy number.
It's a huge psychological barrier, but it's also a verdict. Bloomberg said gold jumped 30% in January alone. When it moves that fast, it's not an investment, it's an evacuation. People are fleeing cash because they don't trust the central banks.
And the other side of that fear trade is oil. The CNBC data on this was pretty startling. Prices jumped more than 4% on Wednesday.
And they are not stopping. As of this morning, Brent crude is up another 1.7%, over $71 a barrel. West Texas is pushing past 66.
A 4% jump in one day? That's not just normal market noise. That feels like a supply shock.
It is. And this connects right back to that inflation fear. Why is oil up? Because the geopolitical map is flashing red. The sources point directly to these joint naval drills between Russia and Iran.
I saw that. And the U.S. put out that warning to Iran to make a deal.
It's a lot of saber rattling, but it's happening in the most sensitive place on Earth for energy markets, the Strait of Hormuz.
Right. Remind everyone why that tiny stretch of water is so critical.
It is the jugular vein of the global economy. The data shows about 13 million barrels of crude pass through that strait every single day. That is 31% of all the world's seaborne oil.
31%. Wow. So if those drills turn into a blockade, or even if one ship gets spooked and turns around?
You take a third of the world's mobile oil supply offline, just like that, and prices wouldn't go up 4%, they double. And here's the nightmare scenario for the Fed and why that hike talk is happening. If oil spikes, inflation spikes. It gets into the price of everything.
And if inflation spikes because of oil, the Fed cannot cut rates.
Exactly. They might have to hike into a slowing economy. That's the textbook recipe for stagflation. And that is why the stock market's green ticker tape feels so disconnected from reality. The stock market is betting on a perfect landing. The commodities market is pricing in geopolitical emergency.
It's interesting you say that because I saw a little note from JP Morgan in one of the reports. Amidst all this, they seem to be suggesting investors look, well, elsewhere.
They are. JP Morgan is explicitly saying they prefer international stocks over U.S. ones right now.
That seems counterintuitive, right? The U.S. market is the one hitting all-time highs.
It's a volatility call. They're looking at the U.S. and they see a Fed at war with itself, a White House at war with the Fed, and sky-high valuations. They're telling clients, maybe let's put some money in Europe or Asia where the president isn't suing the central banker over construction delays. It's a defensive move.
A defensive move while the NASDAQ is rallying.
Okay.
But speaking of the NASDAQ, we have to talk about the one sector that seems to be in its own universe, tech.
The Teflon sector. Nothing ever sticks.
Well, there was a big move in the SEC filings from NVIDIA. Can't have a show without talking about them.
You really can't. And this is a big one. The filings show that NVIDIA has sold its entire stake in ARM.
The whole thing. Now, for people who don't know, ARM is the British chip designer that's in basically every smartphone. NVIDIA tried to buy them a few years back, and now they're completely out. What do we make of that?
Well, it could just be simple profit-taking. But given the whole geopolitical climate, it feels more strategic than that. Like NVIDIA is clearing the decks, you know? Maybe they don't want exposure to a foreign-held asset, even a friendly one, with things getting so tense.
It seems to tie into this bigger picture of the global AI race. The CNBC sources had a fascinating interview with Sam Altman of OpenAI, and his tone really surprised me.
About China.
Yeah, I mean, the usual American line is we're way ahead, they can't catch up. But Altman called the progress of Chinese tech companies remarkable and amazingly fast.
Amazingly fast? That's not what you say when you think you've already won. He admitted that in some areas they are right there near the frontier. It's an acknowledgement that despite all the bans and trade walls, China is still innovating at a shocking pace.
And that race is leading to some huge geopolitical moves. I kept seeing this term in the notes, Pax Silica.
Pax Silica. It sounds like something from a sci-fi novel, doesn't it?
It really does. But it's a very real policy.
It is the Trump administration's core doctrine. You know, Pax Americana was peace through military strength. Pax Silica is about dominance through control of the silicon supply chain. The whole idea is to build a fortress around chip manufacturing with the U.S. and its allies.
And the big news today is who's joining that fortress?
India.
That feels like a massive deal.
It's a game changer. The report says it'll be made official at the AI Impact Summit in New Delhi. By bringing India into this Pax Silica alliance, the U.S. gets a huge market, a massive labor force, and a strategic counterweight to China. It's basically drawing a line in the sand, a silicon curtain, if you will.
A new Cold War, fought with GPUs. Wow. Before we leave OpenAI, though, there was a smaller detail that's probably more relevant for listeners. We've all been wondering how ChatGPT is going to make money to justify that $70 billion valuation.
Monetization question.
And Altman hinted at it. He talked about Instagram-style ads inside ChatGPT.
I saw that. And it makes total sense, really.
Does it? I feel like people use it to get away from the ad-cluttered mess of search engines.
That's true. But think about it. If you ask ChatGPT for, say, a travel plan for Tokyo, and it suggests a specific hotel or a good flight deal, that's not just an ad. That's a high-intent, useful recommendation. He called it discovery.
So my AI assistant is about to become a very polite, very effective salesperson.
Inevitably. You don't raise that much capital without having a plan to turn on the revenue fire hose.
Fair enough. Okay, let's pivot to our last segment. We've covered the Fed, commodities, and the tech Cold War. Now we need to talk about where money and politics collide in the most literal sense. Crypto.
And this is where the lines get very, very blurry.
Senator Elizabeth Warren sent a blistering letter to the Fed and the Treasury, basically demanding they promise not to bail out crypto.
Her argument is pretty straightforward. She's saying taxpayers who back the traditional banking system shouldn't be on the hook to prop up Bitcoin or save crypto billionaires who made huge, risky bets.
And the context here is that the crypto winter is back. Bitcoin has lost about half its value since its October high.
It's a deep freeze. The report listed the numbers, and they're staggering. Binance's Changpeng Zhao down nearly $30 billion. Coinbase's Brian Armstrong lost $7 billion. Just massive wealth destruction.
But Warren wasn't just making a general point. She took aim at a very specific target.
She did. She highlighted what she sees as a massive conflict of interest involving President Trump's own crypto venture, World Liberty Financial.
Right, the company his family launched.
Exactly. And this gets a bit technical, but it's important. According to the reports, the company was in debt for about $11.75 million. To pay that off and avoid being liquidated, they sold around 173 wrapped Bitcoin.
Okay, for anyone who doesn't live on Discord, what exactly is wrapped Bitcoin?
The easiest way to think of it is like a casino chip. You can't use a gold bar at the poker table, so you trade it for a chip that represents that gold bar. Wrapped Bitcoin is just a token on another blockchain, like Ethereum, that represents a real Bitcoin locked up somewhere else. It lets you move the value around more easily.
So the president's company used these digital casino chips to pay off its debt and survive, while the rest of the market is in flames.
Correct. And Warren's point is, if the president's own company is using these unregulated tools to save itself, and then his administration turns around and pushes the Fed or Treasury to bail out the crypto sector, well, he's directly bailing out his own business. It's a huge conflict of interest claim.
What a tangled web! You have the president nominating a new Fed chair, suing the old one over renovations, and his company trading crypto derivatives while senators are screaming about bailouts.
It is the definition of a complex system. And to top it all off, there was one last headline on this about the Trump family and the dollar itself.
The dollar upgrade. I saw that.
Yes, they're arguing that the U.S. dollar needs an upgrade.
That is incredibly vague. What does that even mean to the market?
It means instability. When the leadership of a country starts talking about upgrading the world's reserve currency, investors get nervous. Is that a digital dollar? A crypto peg? We have no idea. But when you pair that with gold at $5,000, it tells you that faith in the dollar is being tested from the top down.
Okay, so let's zoom all the way out. We have a schizophrenic Fed, a potential war in the Strait of Hormuz, a new silicon curtain being built, and a crypto battle in Washington.
The word for today is divergence. You have the stock market acting like everything is perfect. Growth is back, tech is unstoppable. But then you have the bond market, through the Fed's hike talk, and the commodities market, with gold and oil. And they are screaming caution. They're pricing in war, inflation, and institutional failure.
And historically, who tends to win that argument? The stock market optimists or the bond market realists?
The bond market is almost always the smart money in the room. You know, stocks can run on hype, but bonds run on math. And when the bond market is worried while the stock market is partying, it's usually the bond market that ends up being right. The fact that gold is at 5,000 tells you there is deep systemic fear out there.
So if those red signals are the ones to watch?
The green tape is a trap. If oil spikes because of Hormuz, the Fed can't cut. In fact, like those officials hinted, they might be forced to hike.
And if they hike in 2026?
The stock market rally hits a brick wall hard.
That is the sober reality check we needed today. It sounds like that JP Morgan advice to maybe look abroad could be the most prudent thing we've heard.
I think so. Don't assume the U.S. is the only game in town, and definitely don't assume that a rising S&P 500 means the underlying economy is safe.
Before we go, what's the final thought for everyone to chew on?
I want you to just sit with this one question. You have a White House saying inflation is dead. You have a Federal Reserve that is openly discussing hikes because they think it's still alive, and you have gold at $5,000 an ounce. Ask yourself, who is actually reading the economy correctly? Because they can't all be right. And more importantly, is your portfolio ready for a world where that surprise hike, the one absolutely nobody on Wall Street is pricing in, actually happens?
That is the question to ponder over your morning coffee. Thank you for helping us navigate all the noise today.
My pleasure.
And thank you all for listening. Keep your eyes on the headlines, but keep your mind on the underlying data. As always, we'll see you all tomorrow morning with new headlines from major financial magazines.